And now for our currency of the week, pound dollar. Keep calm and God save the Queen. So, pound dollar, here's a picture of Nigel Farage, head of UKIP, or former head of UKIP, and Donald Trump, the president-elect of the United States of America. These were the big shocks of 2016, Brexit and the election of Trump. Now, we're in 2017, and it's time for the implementation of these shocks. Trump will enter office on January 20th, and Article 50 in the UK, the official announcement that the UK is leaving the European Union, this will be triggered in March, okay, according to the timeline set by the British government. This means high volatility that will, we already had lots of volatility in 2016, and we'll have more soon. Now let's break it down to the details. Let's talk about what's good in the United Kingdom. Well, for the economy, for the pound, the UK economy is still looking good. Retail sales, GDP growth, PMIs. Okay, we had this PMI yesterday that was really positive, 56 points. That reflects strong growth. And perhaps most importantly, the Bank of England, led by Mark Carney, has shifted its stance from dovish to neutral. In August, they cut rates, announced more QE. In November, they told us that, well, we've had enough for now. We don't intend to cut rates once again. That's the good thing. These things keep the pound good. And now let's move to the negative things. There's still worries about the hard Brexit. We don't really know what the government is about to do. Hard Brexit, just to clarify a bit, what is a hard Brexit? What is a soft Brexit? When we talk about a hard Brexit, we talk about big breakup with the EU. That means that the UK gets to fully control immigration, what some Brexiteers want, but no access to the single market. That means customs, tariffs, things that will dampen the UK economy. A soft Brexit is something like the Norwegian model, officially being out of the European Union, but paying to stay in the single market, accepting immigration, and having access to markets without tariffs. That means basically the current situation, but without having a say, that needs your ability to change agreements. Okay, so these are worries that still exist because we don't know what the government is about to do. Yesterday we had a development. Yesterday we had the UK ambassador to the European Union, Ivan Rogers. I hope I'm not making a mistake with his name. Sir Ivan announces his resignation ahead of time. And that's a bad start to 2017. In his letter, he said that he told his colleagues that they should speak truth to power, and they should talk about the difficulties of the Brexit negotiations, sort of left with the storm, as they say. And that's a bad sign for 2017, a bad start because, well, he would have been one of the key negotiators. There's fresh talk about companies leaving London. We're talking about banks. We're talking about other companies, not only London, the UK in general. And watch out for the rise in jobless claims. So the UK employment situation has been really great. In the past few years, more people got into the workforce, and the unemployment rate fell under 5%. And jobless claims, of course, the more frequent or high-frequency data, these were falling. But in the past few months, we've seen jobless claims on the rise. It takes time between seeing jobless claims rising and unemployment rising. We should keep an eye on that. And another thing we talked about in the show a few times, when Article 50 is actually triggered, even though everybody knows it's going to be in March, it's still a big historic moment, and it could still spell trouble. That's when negotiations begin. That could be a difficult moment for the pound. Okay, that was the UK. Now let's move to the United States of America. And again, let's begin with the good news. So, first of all, high expectations for Trump. What do we expect from Trump? He promised to boost the US economy, fiscal stimulus, cutting taxes, spending on infrastructure, not cutting on Medicare, Medicaid, and spending more on the military. So if we have all this kind of fiscal stimulus, we'll have a steaming economy that will lead to rising inflation, and that leads to higher interest rates, an accelerated path of interest rates. Okay, and that of course supports the US dollar. The Fed already recently upgraded its hike forecast for 2017 from 2 to 3 hikes. Remember that the Fed usually has to admit that the economy is not doing as well as they had expected. So this upgrade from the Fed is all positive for the US economy, and the data, most of it is looking good. Most recent piece of data has been the ISM manufacturing PMI, but it's certainly not the only one. Okay, let's continue with the negative things in the US economy. And we're talking about, well, I think expectations for Trump's stimulus are a bit too high, okay? Because markets, took too much of this Kool-Aid and think everything will be great. In reality, for economic decisions, the United States president, whichever president, has to get the approval of Congress, and Republicans may be reluctant to approve his crazy plans, and he made also contradictory statements. In addition, it's important to remember that Trump promised, and with his recent tweets, he also wants to get jobs back to America, manufacturing jobs, to fight back Mexico with the wall, you can see here below, and to fight China, okay? And markets have been ignoring this at large, and these trade war risks have been brushed off. It's far from over. So if we have less stimulus and more trade frictions with China, with Mexico, with other countries, it's bad news for the US economy and bad news, well, for the global economy in general. So my conclusion is bearish on pound dollar. Of course, we have negative things to say about the US economy, but the situation in the UK has further room to deteriorate. Brexit can bite and can become hard reality. And I think it will still take a few months for a Trump disappointment. Markets are going to give credit, let's say, for 100 days, okay? In general, if we look at central banks, if we put politics aside, we have the Fed that is still hawkish, still set to raise rates. And even though the Bank of England is not dovish like the European Central Bank or the Bank of Japan, it is only neutral in comparison to the Fed's hawkishness. This puts the US dollar at an advantage against the pound. So I believe that we can still see pound dollar falling in the near future. And we could reach uncharted territory to the downside. Let's conclude this Currency of the Week episode segment with looking at the pound dollar chart. So the wider picture, currently we're trading between 122 to 123. These are the levels to watch. On the top side, if my forecast is wrong, and of course I may be wrong, 123.80, 125, and there 127.30. The initial post-Brexit low in late June was 127.90. And now let's look to the downside. Let's move to the daily chart. So here the levels we are watching are under 122. We have 121. Then we have 119.50. We had this flash crash back in October where we've seen even lower levels. Okay, and I believe that 115, not related to the flash crash, but the next round number is certainly possible in case bad news materializes and for the pound and the dollar remains stable. Okay, so this is the currency of the week, the pound. And now let's preview next week, the week of January 9th to January 13th.